The greatest blunder most speculators commit has little to do with selecting the right stock or pinpointing the precise entry moment. It lies, instead, in a fundamental misunderstanding and a reckless disregard for position sizing. This oversight, more than any other single factor, consistently leads to catastrophic losses that could otherwise be avoided. The market, a relentless and unforgiving entity, offers no quarter for such negligence. Even the most brilliant analysis, a perfectly conceived trade, can be rendered entirely useless if the size of the position leaves one excessively vulnerable to the market's inevitable, routine fluctuations. This, a seasoned speculator observes, is where many fortunes are silently, almost imperceptibly, squandered. Subscribe now, leave a like, and write any comment. This way, you'll help more people see and hear this message, and I'll know that my work is not in vain. Beginners, in their eager pursuit of riches, frequently fall prey to a common, yet fatal error. Their focus rests exclusively on the potential profit. They envision the grand gains, the rapid accumulation of wealth, while utterly neglecting the looming shadow of potential losses and their devastating impact on the trading capital. This tunnel vision, this myopic view of the market, blinds them to the necessity of prudence. A true speculator knows that the first rule of the game is capital preservation, and that rule begins and ends with how much one risks on any single venture. The promise of immense returns often seduces the unwary into taking on immense, unmanageable risks. The psychological dimension of this error cannot be overstated. The burning desire for quick wealth, the irresistible urge to get rich fast, consistently pushes individuals into taking on excessively large positions. They ignore all the clear warning signs, the historical precedents of failure, and the cold, hard logic of probabilities. This unbridled optimism, bordering on recklessness, is often the emotional driver behind poor sizing decisions. It's a gamble, not a trade, fueled by hope rather than reasoned calculation. The market, in its ceaseless dance, operates on its own terms, indifferent to an individual's hopes or dreams. It will test every conviction, exploit every weakness, and punish every act of indiscretion. An oversized position invites precisely this kind of merciless exploitation. It forces a speculator to react emotionally, to make panic decisions, and to abandon sound principles at the very moment they are most needed. The initial misstep in sizing sets off a chain reaction, leading to forced sales, capitulation, and ultimately, the complete eradication of hard-won capital. Therefore, it becomes paramount to fundamentally rethink one's approach to every single unit of capital committed to the market. Each dollar, each pound, each cent is a soldier in one's financial army, and their deployment must be strategized with the utmost care and respect for the inherent dangers of the battlefield. The market is not a place for the impulsive or the careless. It demands discipline, foresight, and a profound understanding that the path to lasting success is paved not with oversized gambles, but with meticulously managed risks. This is the first, and perhaps most difficult, lesson to truly absorb. Consider your trading capital as your personal army, and the market itself as the vast, unpredictable battlefield. Each position you take represents a detachment of your troops sent into the fray. The size of that detachment, the number of soldiers you commit, determines far more than just your potential gains. It dictates your level of vulnerability, your capacity to withstand the inevitable skirmishes, and ultimately, your very ability to remain in the fight. To deploy your entire army, or even a disproportionately large part of it, into a single engagement, no matter how promising, is an act of financial suicide. A fundamental principle of warfare, and indeed of speculation, is the preservation of reserves. No wise general commits all their forces at once. They hold back a significant portion, ready to reinforce success, shore up defenses, or launch new offensives as conditions evolve. Similarly, the astute speculator never risks their entire capital, nor even a substantial portion, on one or two large positions. Maintaining ample reserves provides the crucial flexibility to adapt to changing market conditions, to capitalize on new opportunities, and to absorb the inevitable, often unexpected, blows that the market delivers. Without reserves, one is always on the brink of being wiped out. A truly intelligent trader always prioritizes the defense of their capital above all else. Position sizing, therefore, is primarily a defensive tool, not an aggressive one. It is the means by which one limits potential damage, ensuring that no single trade, no matter how wrong it goes, can cripple the entire trading operation. The size of your commitment should always be dictated by the maximum tolerable loss, not the maximum dreamed of profit. This defensive posture ensures longevity, allowing the speculator to survive the inevitable lean periods and be present when the truly lucrative opportunities emerge. It is a bitter lesson, but a necessary one, that even a correct move in price can destroy a speculator if their initial position was too large. The market rarely moves in a perfectly straight line. There will be temporary reversals, sudden corrections, and sharp whipsaws designed to shake out the impatient and the overleveraged. If one's position is excessively large, these temporary fluctuations, even if the underlying trend is correct, can trigger a margin call, force an untimely exit, or simply exhaust one's mental fortitude. The inherent volatility of the market demands that one's stake is modest enough to ride out the storm. The market, above all else, demands survival. And survival, in this brutal arena, is only possible through the most rigorous and intelligent management of one's capital. Reckless deployment, driven by greed or impatience, guarantees a short and painful career. The speculator who consistently risks only a small percentage of their total capital on any single trade, who always maintains substantial reserves, is the one who endures. They are the ones who learn the subtle rhythms of the market, who patiently wait for the clearest signals, and who ultimately reap the greatest rewards. This is not about being timid, it is about being strategically sound. Within every speculator resides a pair of relentless internal adversaries, fear and greed. These powerful emotions, often unseen, directly corrupt and distort decisions regarding position sizing, leading to outcomes that are almost invariably detrimental. The market does not care for an individual's hopes or anxieties, it simply exists. Yet, an individual's emotional state, particularly when dealing with capital at risk, can tragically dictate the very size of the commitment, turning a calculated venture into a desperate gamble. Greed is the more common, and often more dangerous, of the two. It pushes the speculator to overload positions, to commit far more capital than prudence dictates, driven by an insatiable desire to catch up on past losses or to extract maximum profit in the shortest possible time. The vision of immense, rapid gains blinds them to the reality of amplified risk. This urge for excessive exposure is a direct path to ruin, for it fundamentally misunderstands the nature of probabilities and the necessity of managing downside. A market that appears to offer easy money often hides the most cunning traps, and greed leads one directly into them. Conversely, fear, though seemingly the opposite, can be equally paralyzing and destructive. It might manifest as an inability to take any meaningful position at all, leading to missed opportunities, or, more insidiously, as a reluctance to exit an oversized, losing position. The fear of realizing a loss, of admitting error, often causes speculators to hold on to bad trades, allowing small, manageable drawdowns to balloon into catastrophic losses. This emotional attachment to a losing bet, driven by dread, is the antithesis of disciplined trading, turning what should be a cold, rational decision into an agonizing emotional ordeal. Subscribe now, leave a like, and write any comment. This way, you'll help more people see and hear this message, and I'll know that my work is not in vain. Every decision regarding the size of a position must be devoid of emotional influence. It cannot be dictated by the thrill of an imagined win or the panic of a perceived loss. Position sizing must be a cold, rational calculation, based on established risk parameters and a clear understanding of one's capital and psychological limits. When emotions are permitted to dictate the amount of capital to risk, the results are almost inevitably disastrous. The market does not reward emotional trading, it merely takes advantage of it. Therefore, cultivate an iron self-discipline and an absolute detachment from the immediate outcome of any single trade. Do not permit the allure of quick riches or the terror of temporary losses to dictate how much capital you expose to the market. Understand that the market is a perpetual test of character, not just intellect. The capacity to make dispassionate decisions about position size, to adhere rigorously to a predefined risk management plan, is the hallmark of a serious, enduring speculator. It is the clearest indicator of whether one is truly in control of their actions, or merely a puppet of their own internal whims. A critical principle in market operations, often ignored by the impatient, is the concept of testing the waters or reconnaissance before committing substantial capital. The initial position, the first foray into a trade, should be deliberately small. Its purpose is not to capture immense profit from the outset, but to act as a probe, to confirm the validity of one's analysis, and to gauge the market's immediate reaction. This small, experimental stake provides invaluable feedback without exposing significant capital to undue risk. It is the cautious general sending out scouts before deploying the main army. The first few points or price movements following your entry are the most crucial. They either provide immediate confirmation that your market thesis is correct, signaling that the current aligns with your sale, or they indicate, often with brutal clarity, that your initial premise was flawed. When the market moves against your small initial position, it is a definitive signal to retreat, to cut losses quickly, and to reevaluate. There is no shame in admitting error swiftly. The shame lies in clinging to a false premise and allowing a minor setback to escalate into a major defeat. This early warning system is one of the most vital aspects of intelligent speculation. True, intelligent scaling of a position, often referred to as pyramiding, should only occur after the market has definitively confirmed the rightness of your initial judgment. This means adding to a winning position, increasing your stake as the trend you identified strengthens and moves in your favor. This method of scaling, where you add to positions that are already proving profitable, leverages confirmed success. The capital you add is, in a sense, being risked on a trade that the market itself is already validating, making it a far more prudent maneuver. The absolute fastest route to financial ruin is the tragic act of adding to a losing position. This is the ultimate emotional trade, devoid of logic or discipline. The desperate hope that a declining stock will turn around, that a small loss can be averaged down into a profit, is a siren song that has lured countless speculators onto the rocks. This is not strategic scaling. It is doubling down on error, throwing good money after bad, and guaranteeing that a correct initial assessment of risk is utterly abandoned in a fit of delusion. It is a profound act of emotional surrender, inviting complete destruction of capital. Therefore, cultivate the virtue of patience and the unwavering ability to await clear confirmation from the market before risking larger tranches of capital. Begin small, let the market prove you right, and only then, with measured steps, increase your exposure. This disciplined, methodical approach to position sizing, characterized by an initial cautious probe followed by calculated scaling into confirmed trends, will protect your capital, preserve your mental composure, and ultimately lead to consistent profitability. It is a testament to genuine market wisdom, built on observation and strict adherence to proven principles. The most profound lesson embedded within the principles of position sizing is not merely about maximizing profit, but about ensuring survival. The market will always be there tomorrow. Your capital, however, may not. Every speculator is granted a ticket to participate in this grand arena, and that ticket is their trading capital. Incorrect position sizing, reckless exposure to undue risk, is the swift and certain means by which one loses that ticket, often permanently. The most brilliant insights, the most astute analyses, are utterly meaningless if one is no longer in a position to act upon them. Understanding this principle separates the fleeting gambler from the enduring speculator. The gambler risks everything on a single turn of the wheel, hoping for a monumental payoff, and often ends up with nothing. The serious speculator, by contrast, understands that true wealth is accumulated not through one gigantic, make-or-break position, but through a series of intelligent, controlled operations where risk is always meticulously contained. It is the compound effect of small, consistent gains, protected by stringent risk management, that builds enduring fortunes. The market is a marathon, not a sprint, and survival is the fundamental prerequisite for winning. Correct position sizing provides the crucial resilience needed to withstand the inevitable punches the market delivers. There will be periods of unfavorable volatility, unexpected news, and times when even the most carefully planned trades go awry. If your positions are sized correctly, these setbacks become manageable learning experiences, drawing down a small portion of your capital but leaving the majority intact for future, more promising opportunities. It allows you to remain liquid, flexible, and mentally unburdened, ready to seize the next significant trend when it presents itself. The greatest fortunes in market history were not built on singular, colossal bets, but on a sustained series of prudent, disciplined operations. These legendary speculators understood that the market is a test of character as much as it is a test of intellect. Their ability to remain calm under pressure, to adhere to their rules, and crucially, to manage their risk through intelligent position sizing, allowed them to ride out the inevitable storms and capitalize on the long-term trends. Their success was a testament to patience, calculation, and an unwavering commitment to self-preservation. Therefore, embrace the ultimate lesson. Always stay in the game. This demands a severe, unwavering discipline, a cold, detached calculation in every decision, and a profound understanding that your capital is your lifeblood in this arena. Let your position size be your truest indicator of your discipline and your respect for the market's power. It is the constant reminder that the objective is not to be right on every trade, but to be right enough times, and to survive long enough, to let the powerful trends work in your favor. This disciplined approach to position sizing is the ultimate guarantor of your longevity, and ultimately, your triumph. Subscribe now, leave a like, and write any comment. This way, you'll help more people see and hear this message, and I'll know that my work is not in vain.